Down 1.7% here, a loss of 37 points or so. Apple shares were just getting hammered this morning.
We're down by between 3 and 4.5% generally across these markets. Let's talk about the speed with which we are watching this market deteriorate. We're red everywhere, essentially, down by 4-5%.
We're down over 16%. Dow at the same time has fallen about 18%.
The stock market is now down 21%.
We're now down 40.
Financial crises are times when the economy breaks down, banks fail, people lose money, and businesses close. They often happen when too much money is borrowed or when risky decisions go wrong. In this series, we'll look at 5 major financial crises in history to understand what caused them and how they changed the world.
Things still need to be done. Business as usual, as far as I know.
Everyone we're speaking is basically that everyone's job is gone.
Well, that's not what we've been told in finance.
The credit crisis of 1772. This was one of the first major financial crashes in modern history. It started in London, which was a leading center of global trade and finance at the time. The British Empire was growing fast, and trade with the American colonies and Asia was bringing in a lot of wealth. With this growth came a huge demand for credit. Money borrowed to invest in trade, land, and businesses. Banks and individuals were lending money freely, often without proper checks. Investors were using borrowed money to buy shares in companies like the East India Company, expecting prices to rise. This created a risky financial system built on debt and hope rather than stability. The crisis soon began in June 1772 when a well-known banker named Alexander Fortis made large losses by betting against East India Company stock. He couldn't repay the money he owed and secretly fled to France. When news of his escape spread, people panicked. His bank collapsed, and fear spread quickly to other banks and investors. In just 2 weeks, 8 banks in London failed. The panic spread to Scotland, where the Ayr Bank, linked to Fortis' firm, also collapsed. Soon, the crisis reached Amsterdam, where Dutch banks had close financial ties to British trade. Even the American colonies felt the impact, especially farmers in Virginia and Maryland, who relied on British credit. As commodity prices fell and debts were called in, many couldn't repay what they owed. The result was a wave of bankruptcies, job losses, and a sharp drop in trade. Credit dried up, and trust in the banking system was badly shaken. In the colonies, this added to growing anger toward Britain. Some historians believe the pressure from this crisis helped spark the events that led to the American Revolution. This crisis showed how dangerous uncontrolled borrowing can be, and how connected the global economy had already become, even in the 1700s. The Great Depression of 1929 to 1939. While the credit crisis of 1772 showed how financial problems could spread across borders, the Great Depression of 1929 revealed just how deep and long-lasting a global economic collapse could be. It remains the most severe financial crisis of the 20th century. It began in the United States after years of rapid growth in the 1920s, when people borrowed heavily to invest in a booming stock market. By October 1929, stock prices had risen far beyond real value. Unfortunately, in over just a few days, markets crashed. An event known as Black Thursday, Black Monday, and Black Tuesday. The crash exposed deeper problems like risky bank loans, overproduction, falling farm prices, and rising inequality. Banks failed, businesses collapsed, and millions lost their jobs. In the US, unemployment hit 25%, and countries like the UK and Germany also suffered badly. Early government responses made things worse. Later on, New Deal programs created jobs and reforms. But full recovery didn't come until World War II began. The crisis revealed how vulnerable modern economies can be and the importance of timely government action.
That warrants pessimism. That was Black Thursday, but it was not the worst.
The time came when the ticker tape in the broker's office told a new story. It was panic.
The OPEC oil price shock of 1973. After the world had begun to rebuild from the Great Depression and later from World War II, many economies were growing rapidly. But by the early 1970s, another crisis emerged. Not from the banks or stock markets this time, but from a sudden and dramatic rise in the price of oil. This event became known as the OPEC oil price shock of 1973, and it had a serious effect on economies around the world. The crisis began during the Yom Kippur War in October 1973, when Egypt and Syria attacked Israel. In response to U.S. support for Israel, a group of oil-producing Arab countries, led by OPEC, decided to punish the West. They placed an oil embargo on the United States and other countries that supported Israel, cutting oil exports and reducing production. The result was immediate. Oil prices, which had been around $3 per barrel, suddenly jumped to nearly $12 per barrel. That may not sound like much today, but it was a huge increase at the time. In countries like the U.S., long queues were formed at petrol stations. Eventually, some stations ran out of fuel entirely. The price of goods that depended on oil, such as food, transport, and heating, also shot up. This crisis didn't just raise prices. It caused a rare and difficult problem for economies, which we call stagflation. This meant inflation and recession happening at the same time. Normally, inflation and unemployment don't rise together, but in 1973, they did. High oil prices made it more expensive to run businesses, which led to job cuts and slower growth. Governments struggled to respond. Central banks had a hard time managing inflation without making unemployment worse. And because oil was central to so many industries, the shock affected nearly every part of the economy. Many countries realized for the first time how much they relied on foreign oil and how quickly that reliance could become a weakness. The 1973 oil crisis was a turning point. It reminded the world that financial crises can be triggered not only by banks or markets, but also by political decisions and global conflicts. The Asian financial crisis of 1997. By the 1990s, several countries in East and Southeast Asia were praised for their rapid economic growth. Nations like Thailand, Indonesia, Malaysia, and South Korea were attracting foreign investors, building modern cities, and expanding their industries. Their economies were seen as strong and full of promise. But in 1997, things took a sudden turn, and these fast-growing economies fell into crisis. The problem began with too much foreign borrowing. These countries had taken large loans in US dollars to fund projects and businesses. At the same time, their local currencies were kept at fixed exchange rates, often tied to the US dollar. As long as investors were confident, money kept flowing in, and everything seemed fine. But in Thailand, trouble started when property prices fell and loan defaults increased. Investors began to worry that this high government would not be able to keep its currency stable. In July 1997, Thailand gave up its fixed exchange rate and allowed its currency, the baht, to float freely. It quickly lost value, and panic spread. Soon enough, investors pulled their money out of other nearby countries, fearing similar problems. One after another, the currencies of Malaysia, Indonesia, and South Korea collapsed. Stock markets fell, businesses closed, and millions lost their jobs. In Indonesia, inflation soared, and political unrest followed. South Korea came close to running out of money and had to seek emergency help. The International Monetary Fund stepped in with bailout packages, giving loans in exchange for major economic reforms. Countries had to cut government spending, raise interest rates, and clean up weak banks. While some of these steps were necessary, others made the pain worse in the short term, especially for ordinary people. The Asian financial crisis showed how quickly investor confidence could disappear and how fast a problem in one country can spread to others. It also revealed the risks of heavy borrowing in foreign currencies and the dangers of depending too much on short-term investment money. But despite the hardship, most of the affected countries recovered over the next few years. But the crisis left behind important lessons about financial stability and the need for stronger systems to handle sudden shocks. Finally, the financial crisis of 2007 to 2008. This was the most serious global economic crisis since the Great Depression. It began in the United States, but quickly spread across the world, causing bank failures, a massive loss of jobs, and a deep global recession. This time, the problem came from inside the financial system itself, specifically from the housing market and the way risky loans were handled. In the early 2000s, housing prices in the U.S. were rising quickly. Banks began giving out large numbers of home loans, even to people with poor credit histories. These were called subprime mortgages. Many borrowers were offered low interest rates at first, but their payments would later increase instantaneously. Most people believed housing prices would keep going up, so they didn't worry. Banks then bundled these risky loans into financial products called mortgage-backed securities and sold them to investors around the world. These investments were meant to spread the risk, but many investors didn't fully understand how unstable they were. When interest rates rose and housing prices stopped climbing, many homeowners couldn't afford their payments. Foreclosures increased, and the value of mortgage-backed securities began to collapse. Banks and investors that had bought these products started losing huge amounts of money. In 2008, the situation reached a breaking point. The investment bank Lehman Brothers collapsed, and confidence in the entire financial system dropped. Banks stopped trusting each other, and lending froze. Companies couldn't get loans, and people began losing jobs at alarming rates. In the U.S. alone, millions of jobs were lost, and unemployment doubled. The government then stepped in with emergency plans. In the U.S., the government created a bailout program called TARP.
Meanwhile, a new report says Treasury Secretary Tim Geithner should ask banks for more information on how they're using billions of dollars in government bailout money. Special Inspector General looked at 360 banks that have received TARP funds, among them Bank of America. The report says Treasury does not do enough to find out what banks are doing with TARP money. The response from Treasury, it says it has not been able to accurately track the funds to particular loans or investments.
Spending hundreds of billions of dollars to save banks and restore confidence. Central banks around the world also cut interest rates and provided extra funds to keep their economies afloat. The crisis led to deep changes. New laws and regulations were introduced to prevent the same mistakes, including tighter rules on banks and more oversight of financial products. Still, the recovery was slow, and the effects were felt for many years, especially by working families and small businesses. This crisis reminded the world that even advanced financial systems can break down if risks are ignored, and that protecting the economy requires careful regulation, transparency, and responsible lending. Each of these 5 crises, from the collapse of credit in 1772 to the global meltdown in 2008, shows how fragile financial systems can be when risks are overlooked. Whether it starts with too much borrowing, a sudden loss of investor confidence, a political decision, or poor regulation, the pattern is often the same: rapid growth followed by a sharp fall. If you enjoyed watching this video, please leave a like, share, and subscribe to our channel to catch up on a lot more historical events. Stay tuned, and we'll see you next time.